Thanks for joining us for the Weekly Forex Outlook at xm.com. Next week, the spotlight will fall on U.S. core PCE inflation and Eurozone flash CPIs, both out on Friday. We'll also discuss Chinese PMIs due out the same day and the potential reaction in the Australian dollar. I'm Maria Pashardvias, and joining me is lead investment analyst Rafi Boyadjian. So Rafi, let's begin in the U.S., where energy prices are rising again. Can you tell us about the current state of inflation in the U.S. and how the upcoming PCE numbers might impact the Fed's next moves? And what reaction might we see in the dollar?
Well, Maria, that is right. So this latest rise in oil prices that we're seeing has created a bit of a complication for central banks, just as inflation was starting to come down. So we did see a US CPI, the headline figure, edge up for 2 months in a row. Probably it's going to be transitory, but it has caused a little bit of unease in the markets. So next week we're going to see whether or not the higher energy prices have started to feed into PCE measure of inflation as well. But what the markets focus more, and also what the Fed focuses more on, is the core PCE, which does strip out volatile items such as food and energy. So core PCE had ticked up slightly last time, but we should see it potentially edge a little bit lower from 4.2 to 3.8 or 3.9%. And if that turns out to be the case, then that would definitely provide a bit of relief both for the Fed and the markets. But the other concern for the Fed is the fact that consumption in the US had been incredibly strong during the summer. So we're going to see whether or not we're continuing to get strong consumption in the US. So August, maybe we might see a bit of moderation from 0.8 to 0.5% month-on-month growth. But it's still, of course, that wouldn't be enough to decide whether or not the Fed is going to raise rates one more time. Of course, this week the Fed did signal potentially one more rate hike in 2023. Before markets were focusing on November. Now that hike might not come until December. So clearly, this data will be pretty important in terms of building the case for either staying on pause or for raising rates one more time. There's going to be a bunch of other data to watch out for, a lot of housing data as well, durable goods orders, as well as the final estimate of GDP growth in the second quarter. But the other thing that might actually spook markets is the possibility of a government shutdown. So Congress has just 1 week left to avert either a full or partial government shutdown, because they still haven't reached an agreement on a new spending bill. And the problem isn't just in terms of disagreements between the Republicans and Democrats, but even within the Republican Party, there seems to be a bit of a disagreement. So a Republican majority House leader Kevin McCarthy has been struggling to get Republicans to come on board in terms of his solution for avoiding shutdown. So that's something that could potentially keep markets on edge of the coming week.
Moving over to Europe now, higher energy prices are also a concern for the ECB. We'll get the September flash estimates of the harmonized indices of consumer prices on Friday. What are we expecting there, and how might the euro be affected?
So the ECB just not that long ago, they announced a policy decision. They kept rates. Actually, they hiked rates, but signaled that probably that will be the last one. And the euro had, it has been struggling against the US dollar, because it's not just the fact that we're more likely to get one more rate hike in the US than in the euro area, but also the fact that the Eurozone economy is facing a prolonged period of stagflation. So this is what's going to be interesting to see in the coming months, whether or not should we see some good inflation numbers in terms of lower than expected CPI readings. Is that going to be good for the euro, or is it going to be bad? Because on the one hand, weak inflation data would bolster the case for the ECB in the immediate term to stay on hold and then into 2024 to start cutting rates. It would low inflation numbers would also boost the growth prospects for the euro area. So any downside might be limited, and as we and because what we're expecting to see from the forecast is that headline inflation in the euro area will fall from 5.2 to 4.6. The core figure should edge down from 5.3 to 4.9. So if we do get such numbers, then maybe it might not be so bad for the euro because it would ease stagflation risks.
And finally, over in China, the PMI surveys for September will provide some insight into the state of the Chinese economy, which has struggled a bit to recover after the pandemic. Have there been signs of improvement, and what might this data mean for the Aussie?
Yes, so we have been seeing some very tepid indications that maybe things are stabilizing in China. That's already appeared to have helped support sentiment a little bit in Asian markets. We're also seeing that effect on China-sensitive currencies such as the Australian and New Zealand dollars. So next week we've got the manufacturing PMIs coming up, and should we see further signs of improvement there, then that would reassure markets that the government's approach to boosting the economy in terms of this drip-feed stimulus, that maybe the cumulative policy responses are now starting to take effect. And even if we don't see huge rebound in economic activity, at the very least, the government is definitely trying to prevent a deeper crisis. So potentially, should we see some more positive, if not incredibly positive, but somewhat encouraging PMI data coming out of China, that would be positive for both equities and for currencies such as the Aussie.
Rafi, thanks so much. This was the Weekly Forex Outlook here at XM.com.